Problem 29A addresses return on investment and residual income as key performance indicators to evaluate investment centers. So we begin with the income statement for Safe Money, and it tells us that the company's target rate of return is 20%. So we can see their sales, cost of goods sold, and gross profit, operating expenses, all the way down to net income. Remember, we're going to need some key figures for return on investment, operating income, sales, total assets. So if we've got the information that we need from the income statement, and we've got the information that we need from the balance sheet. So if we move to our requirements, it asks us to calculate return on investment, profit margin ratio, asset turnover ratio, the expanded return on investment formula, and residual income. So let's take a look at each of these. Using the information above, the company has calculated the return on investment using operating income of $450,000 divided by, notice it says average total assets. So we took assets at the beginning of the year plus assets at the ending of the year and divided by 2. Let's go back up and check our numbers. Operating income. Where did this come from? Operating income is in the middle of the financial statements. Remember, sales less cost of goods sold, less selling general administrative expenses get us down to operating income. And this is what we're using because this is the income that has been generated as a result of daily operations. Now we have other expenses such as interest and tax, but these are more administrative and not really part of the daily operating activity. So we're using operating income to determine our return on investment of $450,000. Then for our average total assets, we're taking assets at the beginning of the year, $410,000, plus those at the end of the year, $590,000, divide by 2 to come up with our average total investments. So our return on investment here is 90%, which is very high. So this is telling us basically that I am generating 90 cents of return for every dollar that I'm spending in assets, which is a very, very good return. We can't get this anything close to this for money laying in the bank. This is the risk that goes along with running a business. Now, the second requirement says let's break it out into its expanded form. Calculate the profit margin, which is operating income. Once again, the $450,000 divided by sales of $9 million. So we have a 5% profit margin ratio, which simply tells us that we earn 5 cents in income for every dollar that we have in sales. Okay, so basically every dollar that I have in sales generates 5 cents of operating income. Well, that doesn't sound quite as significant as the 90% return on investment. So let's look at the second part of this formula, my asset turnover ratio. If I look at my net sales, once again, the $9 million, divided by my average total assets is actually 18. And so if you think about, I'm generating $9 million in sales with around $500,000 in assets. That's very significant. And so it's simply saying that I am generating $18 of sales for every $1 that I had invested of my average total assets. And so now it is these two components together, my 5% profit margin and my my asset turnover ratio of I am turning my assets 18 times or generating $18 of sales for every $1 of average total assets. This is the driving portion of my return on investments here. And so we can see that when we put it in expanded form, 5% profit margin ratio compared to an 18% asset turnover ratio for a complete return on investment of 90%. Now let me say that a profit margin ratio of 5% is not necessarily bad. A lot of times our gross profit margin ratios might be in the double digits, but by the time we get to operating margin ratio and net income ratio as a percentage of sales, these numbers do tend to be in the single digits, even for very large organizations. But 5% of millions or billions of dollars in sales is a significant amount. Right, and finally, we are asked to calculate residual income. And residual income is simply our operating income less our minimum or target amount of income that we should generate. And that minimum amount is our target rate of return, which your text told you was 20%, times our average total assets, which we've already calculated. So the minimum amount of return that I want to generate, the minimum amount of operating income is $100,000 based on a target rate of 20%. Well, remember at $450,000 of operating income, we have a 90% return on investment. So you can see with the combination between return on investment of 90% compared to a target rate of return of 20%, that my operating income of $450,000 exceeds the minimum amount of income that I should generate with my target return of 20%, which is $100,000. So my residual income, actual operating above my minimum acceptable amount, is $350,000. So when we use the residual income and the return on investment together as key performance indicators, we can get a better analysis of how well our organization is actually utilizing the assets that they have and turning those assets into operating income.